Good morning, everybody. Thanks for tuning in. It's Dan Kurz, DK Analytics. It is Saturday morning in Southwest Florida, March 9th, 2019. I've been busy in substitute teaching purgatory while keeping abreast of headlines and developments. And to get into tip-top shape, or at least in that direction this morning, I've also got my old bones active by doing some stretching and 70 push-ups so that I'm hopefully able to get a clear, concise, and hopefully also pithier delivery across to you. Without further ado, let me jump into the topic at hand, those headlines. Namely, last week, the US government, on the heels of the fake shutdown, put out record trade deficit numbers and a 77% wider federal budget deficit. I'm going to delve into those, make some comments, offer again some strategic allocation advice. Before I do, a quick reflection on valuation metrics. The dollar, as I've mentioned in past videos, continues to hang tough, buoyed most recently by being the least dirty shirt in the hamper. I'll get to that. I don't believe that for a second, but that's what the market believes, and thus the dollar, notwithstanding a host of weak news in the U.S. and disturbing financial and trade developments, the dollar is still hanging in there, and in fact is near a 52-week high on a trade-weighted basis. But it closed out the week on a trade-weighted basis at 91.49. It's arcing up. Actually, it was higher, but that's the latest number I have from the Federal Reserve. The 10-year at 2.6%, pretty much unchanged. The S&P has lost momentum in this bear market rally. It's closed Friday at 27.43. Oil WTI at $56.07 per blue barrel. The troy ounce price of gold closed at $12.99, trying to get back above $1,300. And silver is still in the doldrums at $15.36 per troy ounce, obviously all in dollar terms. Now, the U.S. trade deficit in goods hit a record in 2018. Why? Because imports jumped and some exports, including the much touted soybeans, as if that's a leading export by a highly developed manufacturing nation. Soybeans and other farm products, they got hammered by retaliation against U.S. trade policies. In other words, President Trump's misguided trade efforts were no help to the contrary, but we've long stated that that would be the outcome. In fact, the deficit in goods grew 10%. The trade deficit the U.S. has with the rest of the world grew 10% last year to $891 billion, the widest on record. And it's no surprise that the leading trade deficits, China, and then distant second, Mexico, they also reached new records. In fact, the deficit with China rose to $419 billion. The trade deficit in goods only, not goods and services. That's what I'm referring to. I call it the duh factor, as in, why can't anybody figure this out? And in a revisited sense, right? The America's increasingly humongous goods trade deficit is despite lower oil import prices and despite record high modern day oil exports on the back of unsustainable fracking, but we've gotten into that before. And at the end of the day, and here's the takeaway, what the sustained and growing US trade deficit in goods really reflects is a lacking product portfolio competitiveness. No matter what kind of demagoguery to the contrary, but we'll dig into that a bit, and much of it will be familiar, so I'll try to keep it as brief as I can. But I think it's important to mention this because of the allocation or reallocation opportunity, that the disconnect between reality and perception presents, right? The true but unpleasant culprits, again, homegrown problems that beg, homegrown American problems that beg for adult/mature homegrown solutions, right? Chalk and oil sound bites, trade demagoguery, and the silly or sophomoric, quote, manufacturing America is back, unquote, by Trump, are as counterproductive as they are disingenuous. That's what demagoguery is, right? Revisiting litigation sanity. I mentioned to you that corporate America has 2.5 times the legal costs of corporate Europe as a percent of sales. Revisiting regulatory sanity. There are still over 2 million federal bureaucrats, and many of the regulations that the Trump administration claims to have killed weren't even on the books there. Again, more demagoguery. And no agencies have been eliminated, all right? So how can you really get your hands around this if you don't empty the personnel levels, or cull at the very least, if not try to cut however difficult the agencies, and make a principled stand on it with GOP follow through? Well, the rhinos don't, but that's again a reallocation opportunity in the making. I'll get into that. But regulatory compliance costs, focusing in on trying to revisit regulatory sanity, which isn't the case, and that's the real fly in the ointment, together with the other things I've mentioned and continue to. Regulatory compliance still costs over $2 trillion in the manufacturing sector alone, according to a US manufacturing center outfit that goes through and aggregates this. Now, that $2 trillion, more than 10% of GDP, isn't only the cost of compliance, but it retards or stalls speed to market and new product runs, and discourages R&D, and discourages a rejuvenation of product portfolio that would otherwise be possible. So there are multiple and deep-seated negative effects, sort of like a cascadingly negative or a domino theory kind of pull-in at the end of the day in terms of the true economic damage that such insanity triggers. We also, in terms of becoming adults or thinking like adults and stop being kindergartners here in the United States, have to get back to a smaller government, spending less, not more. We have to get back to sound money, whose price offers creditors a real return and is determined by the market, not by central banks or potential central bank machinations or manipulations of the cost of money and capital, whether it's artificially low interest rates or purchasing debt or government bonds out of money created with just imaginary digits or thin air, right? This would also, honest money, end or help end crony bailouts because they couldn't be so affordable. But we need to, as a nation, as a people, as the representatives in government, we need to end crony bailouts, the TARP variety. I went into great detail. And we also need to reverse, before the next market crash, the bail-in legislation on the books in the US and everywhere, where in essence, creditors, depositors, which fund about 50-60% of the balance sheets of leading banks are going to find out that their deposits are not there. I mean, they've all been lent out other than 5% anyway, but instead of having cash, current accounts, and such, they're going to get converted, if necessary, into massively diluted shareholders of failing institutions. We need to get rid of all this crony crap in order to encourage a return to free market capitalism instead of crony capitalism. And by extension, the C-suite, as also mentioned, needs to revisit an organic growth focus. Real money, a real cost of money will help them, right? It will help them do this because they won't be able to focus on financial engineering over winning in the marketplace. They need to, in addition, focus not on outsourcing, but rather on revisiting insourcing and quality control and speed to market. They need to move away from corporate anorexia. It can kill you or the future output of the country and GDP growth. You don't grow GDP by shrinking corporations, right? That this doesn't work. And also, they need to stop the de facto LBOing of corporate America, which are, in aggregate, nothing other than common sense strategic solutions that are crying to be mentioned, much less implemented. But let's get them on the air. But even that is failing because the people that control the media are in bed with the rampant cronyism and redistributionism that runs the show at the expense of Main Street, the expense of liberty, at the expense of honestly earned profits and property right protections related to same. But as mentioned, these flies in the ointment to return to manufacturing robustness, which aren't being addressed but should be, aren't the only ones. It's also very much an educational reform issue instead of misform, reform. In other words, less indoctrination by tenured Marxist professors earning $300,000 a year plus. Much more charter school competition. I can speak volumes about it here in Lee County and what's happening to public schools. And perhaps most of all, the introduction or reintroduction of trade schools focused on graduating people that can make and repair things that can be sold competitively in the global marketplace. Problem is, these kind of suggestions elicit yawns. They're not drop a bomb, shock and awe sort of demagoguery or a slick pill to swallow for rapid snake oil salesman healing of our manufacturing weakness, right? They also embody tough, gritty, grind it out, brick by brick initiatives that will take time to work. I mean, come on. It took a long time to get into this non-manufacturing or lacking manufacturing competitiveness, and America won't get out of it overnight. Much like you don't grow up overnight, become a virtuoso pianist overnight, become an S&P 500 company overnight, or build New York City or Shanghai overnight. This is just common sense. But the initiatives and the necessary reforms and mentioning this and giving it airtime and making a job one instead of blaming China and the rest of the world are not conducive to photo ops and shock and awe solutions. In addition, such changes, very important, would deeply threaten the equally deeply entrenched bureaucrats, their crony pals in the corporate world, from TARP onwards, and the elected leftists' redistributionist / amnesty models. Look, these constituencies, in short, are getting richer and more powerful by the day by short-circuiting the Constitution, the rule of law, free market capitalism, and sound money. These leeches love, these rent seekers, if you will, love the sovereignty, freedom, productivity, and property rights pummeling status quo that Main Street has to endure. Call them, if you will, the new Communist Party, or call them fascists, or call them above the law despots, hell-bent on endless acquisition of power and wealth at the expense of meritocracy, free market capitalism, liberty, and the most opportunities for the most people. Question is related to this, and it all ties back into regaining manufacturing efficacy and turning deficits in trade and elsewhere, and I'll get to the federal government, back into surpluses. But the question is, do we still have a large enough and mature enough constituency, that is voting bloc, to revisit Common Sense 101, Honesty 202 over sound bites, and what really works 303 before it is too late to address an ever larger transfer of America's assets to the rest of the world's creditors. Can we, in other words, begin to reduce the size of our net debtor nation status of over $8 trillion, or are we going to continue to grow it in the direction of $600 billion to $1 trillion per year? Can this be done before the dollar is repudiated by the rest of the world and ends up being a fraction, and by creditors domestically as well, and the dollar ends up being a fraction of what it trades for today? Recall, the dollar is but a 3% stub of what it was in purchasing power when the Fed came into existence in 1913, and if one used honest inflation, is probably under 1%. But equally important, whatever the level is today compared to 1913, if it's only 1%, you can still lose 100% of 1%, right? That's the point. But the allocation implications revolving around this discussion and the ultimate trajectory of the insanity that is policy, and also to blame for the trade deficits and the other deficits, including a federal government deficit, these have huge allocation implications given our asset bubbles in the US, and thus have stunning potential portfolio outcome implications as well. And you know what? I keep mentioning this, and I would be remiss if I didn't mention it once more, and you already know it, right? Call my stance, together with some constitutionalists and honest money people, a contrarian one. It obviously is. Call me a record with a skip, or something that I've been expecting for all too long and hasn't come to fruition, which doesn't mean it won't, but it's a trying period. I get that. What I'm trying to say is, thanks to the utterly misguided investors / pundits who dominate headlines and who subscribe to the nonsense that a growing U.S. trade deficit is actually a sign of a vibrant economy instead of the opposite. These are the kind of takes and positions and convictions that help to lead, together with central banks and reinstitution of puts, investors, to the extent that we still have any, in the wrong direction. In other words, it sustains bubble insanity. In reality, a stout economy featuring good productivity growth would produce a surplus of desirable goods. Think of a growth model concept. The Intels of the world, the Microsofts, whatever manufacturer ends up spreading his goods and having a growing top line ends up doing what? Being able to rapidly decrease the unit cost, sell something for less, and sell even a lot more of it than the price is reduced at. And thanks to a dropping unit cost structure, still make money and more money. That's what constructive deflation, productivity-based deflation is all about. And such an economy spits out more, not less, goods and services, which become more affordable, thus pull in ever more consumers because they are more affordable. And that kind of functioning free market capitalism with sound money and property rights also ends up resulting in trade surpluses, not deficits. So a vibrant economy, the US economy, if it was vibrant instead of a bubble economy, pushed higher through through cocaine, through free money cocaine, would result in large trade surpluses, not trade deficits. Just look at history. So the question is, back to Brazil. America as a whole is increasingly aping, in too many respects, Brazil's permanent potential fame. You remember that Brazil over decades was the new hemisphere, the Western Hemisphere economic giant in the making, and its potential proved to be quite permanent. In other words, it never really all came together, at least not for a protracted period of time, because they didn't embrace free market capitalism and sound property right protections. All right. In that sense, it has America, thanks to its reserve currency status, become a misguided, immature, spoiled teenager of a nation that can conduct trade and financing policies that are destructive. And in so doing, has it become the land of permanent fiscal insanity and a land of permanent manufacturing turnaround potential. That is, until creditors bolt and no longer accept printed dollars in exchange for goods, or if they aren't manufacturing creditors and they're domestic creditors, they just have a sense of foreboding about the avalanche of debt coming to market, overwhelming the demand and thus causing the value of bonds to head south. Either or both, one of them is sure to catch up with the current unsustainable valuation situation. Let me now turn to the U.S. budget deficit. Now I think I've beat the trade numbers and the reasons why they are there and what the implications are to death. Let me shove on or push on to the U.S. budget deficit, which has similar reasons for its existence. Right? The U.S. budget deficit widened the first 4 months of fiscal year 19, starting on October 1st, on the record through the end of January, but it widened by a whopping 77% first 4 months of fiscal 2019. From October to January, this number, this widening 77% higher deficit, 310 billion, underscores what? It underscores the revenue hit from the Republican tax cuts on the one hand and an increase in government spending. All right. Receipts fell 2% to 1.1 trillion. And spending rose an astounding 9% to 1.4 trillion. And this during a period of allegedly strong economic growth, as touted again and again by the Trump administration. Think about this. With increasingly broad-based and spreading economic weakness, be it in exports, in housing, in auto, in retail, and increasingly in the bellwether transportation sector, whether in the stock market or in terms of actual volume of freight forwarded, this index, the volume of freight forwarded, has gone from strength to stagnation to turning down quickly in the last few months. So the question is, with an unraveling economy, the federal government deficit giving transfer payments in the works, given even lower tax receipts resulting from less economic activity, is said to balloon. $2 to $3 trillion could be in the cards based upon current levels and based upon precedents, recent precedents. Call it, if you will, the worst of all fiscal worlds. Less government revenue and much higher government spending. So much for Trump's promise during the election to shrink government, and to eliminate the federal debt in 8 years. And by the way, if one considers off-balance sheet shortfalls, the true deficit, as captured by the US Treasury. How so? Simply by taking a look at the aggregate government debt to the penny on any day from the beginning of October to the end of January, we find that actually the true deficit over the first 4 months of fiscal 2019 in the US, the federal government deficit, was $375 billion, which if annualized would already be $1.5 trillion. That $375 billion ballooning of total public debt during the first 4 months of fiscal 2019 exceeded the same tally a year earlier by a whopping $230 billion, or by 159%. The public federal deficit, by the way, from October 17 through January 18 was $145 billion, right? Contrast with that with 375 that we just got news about. What are the investor takeaways? Well, let me list a few. The biggest debtor in the world, the United States, and the biggest debtor in the history of the world by a country mile, also the United States, continues to pursue a destructive trajectory that guarantees an inescapable implosion / flight out of US dollar-based assets. The cleanest dirty shirt in the hamper bullshit that I addressed at the beginning of my remarks, notwithstanding this fuddy-duddy claim, at the end of the day, it is financing self-sufficiency, national free cash flow generation, or their lack of, instead of massive sustained domestic and global borrowing. That's what's going to count. At the end of the day, that's how things are valued and discounted back and attached to a positive net present value. This is just common sense, right? Consider a corporate parallel, if you would. A company that keeps adding to debt to sustain or grow its top or bottom line eventually has an earnings dilution and a solvency problem. Earnings dilution because interest expense keeps growing, so the operating income doesn't drop fully down or less and less to the bottom line. And at some point, creditors are going to start to get cold feet and might shut it down or cause the company to shrink, or something that's going to obviously negatively impact the earnings residual that shareholders get. And it might well be a loss. Well, a country is ultimately no different than a company. And that same company, whether it adds more debt to dilute earnings or does multiple secondaries to raise capital at low PEs, diluting the living crap out of existing shareholders, That country is just an agglomeration or a collection of families and enterprises. And either they're functional, self-financing, and sustainable, or they're not. They're dysfunctional. Collectively speaking, it's the same thing. And thus the report cards here, whether it's the trade deficit in goods or it's the ballooning federal deficits, are D's, if not F's. Yet contrast this with bubble valuations in US stocks and bonds. That's the risk and the opportunity in terms of allocation or reallocation. Recent days, and this also ties into the dollar's strength, the least 30 shirt and the hamper stuff again. Growing evidence of slumping European growth and sustained reductions in the ECB's, the European Central Bank's, growth expectations has given the dollar a boost relative to the euro. And as the trade-weighted dollar is mostly determined by the euro and to a lesser degree Japan and then other nations, it's given the dollar more legs, even though the dollar is the biggest joke on the planet, in my opinion, in terms of the leading world currencies. But Eurozone's growth, the ECB notched it down from 1.9% last summer to 1.7% for this year, real growth in December, and now all the way down to 1.1%, right? Well, guess what's going on in the United States? The same thing, but never mind, nobody seems to get that. But more specifically, back in Europe, the ECB, while it ended balance sheet expansion, asset purchases, hasn't moved to selling assets like the Fed. And the Fed has just recently indicated that its asset sales, or QT, is going to be a truncated affair, right? Which promises to keep the central bank balance sheet much closer to $4 trillion and getting it back down to $900 billion before the crisis, all right? Before the crisis. And what is the takeaway here? The following. The Eurozone. What is the comparison? What are you looking at when you're comparing one weak currency compared to the other? And we're all going into a bad place, but the question is which currency is going to be more suspect in terms of losing value? And my argument is very strongly the dollar versus the euro and numerous other currencies. Now, let's take a look at this. The Germany and other European nations in the northern part of Europe, Scandinavia mainly, and the Netherlands, thanks to them, the Eurozone as a whole still has, number one, a much lower government deficit to GDP. Number two, lower debt to GDP. Although climbing, it's at about 80%, the Eurozone government debt to Euro GDP, compared to 105% in the United States. Moreover, the Eurozone still generates trade surpluses with the rest of the world, right? And it is also a net creditor economic bloc. Contrast that with the over $8 trillion net overseas debtor position of the U.S., which is moving well beyond that number, even as federal government deficits eclipse $1 trillion, and we're arcing towards a $1 trillion goods trade deficit. For flavor, beyond the ever-increasing deficits, all right, comparing the dollar to the euro, consider that America at all levels, government, corporate, and household, has over $70 trillion in debt, over 3.3 times US GDP, an amount that grew by a whopping 3.1 trillion from November 17 to November 18, as mentioned in the last video. That 3.1 trillion is the equivalent of 15% of US GDP, for goodness sake. Now, let's tie all this together. We've got comparing two weak areas, the Eurozone, the dollar zone, two prolific spending areas, two high debt areas, but there's differences. Again, the Eurozone still is a net creditor bloc. It still shows, thanks to Germany and Northern Europe, a trade surplus, and it has lower debt to GDP. Even though it's moved strongly in the wrong direction, it's a lot less burdensome. But the main thing is, it is a much better bet on the world stage when comparing one currency to the other, because Europe has been self-financing. Even as it reaches for the bottom, like America, it's done so while remaining externally self-financed. In fact, it's grown its creditor status, the Eurozone as a whole. So remember this. In this regard, the external financing addicted, biggest debtor economy in the world ever, the United States, has a central bank balance sheet that accounts for only about 20% of US GDP. Now, that might seem counterintuitive. Well, if it's only 20%, well, what is it in Europe? The ECB in the Eurozone, the ECB's balance sheet is about 40% of Eurozone output, twice as big. And, well, Japan's in a whole other dimension. It's off the Richter scale at over 100% of GDP. So doesn't that suggest that the dollar is less endangered or more credible? Well, I'm going to argue just the opposite, and here's why. Not only has the Fed not done the ultimate perversion, monetary perversion, Frankenstein finance, it hasn't gone to negative interest rates yet, right? And the Fed, if you take a look at the runway of the other major OECD nations or blocs, still has or can state that it can expand its balance sheet one heck of a lot more. Just look at the European zone or the Eurozone in Japan. So think of the relatively large additional dollar destruction runway that the Fed has compared to the EU and Japan. And think of that combined with the huge external and internal financing needs of the United States, which pale in comparison to anybody else. Think then of how much more downward pressure this will bring to the dollar and dollar-based assets when the Fed parrots the ECB, much less Japan, on the balance sheet and interest rate fronts. Takeaway, we ain't seen nothing yet. And the implications for the trade-weighted value of the dollar could be more negative, in my opinion. When the Fed has to rescue a stock market, staying on the same theme, that's going to be worried progressively more about the weaker fundamentals, including the most recent job report, where allegedly only 20,000 were added. Good, it's just a 1 month number, but concentrate on the weak retail, the weak housing, the weak auto, the weak trade report, the increase in debt at all levels. Obviously, this is an incredibly weak economy just waiting to wilt, right? But once this impacts perceptions of the stock market and we start having employee terminations and companies roll over and can no longer buy back stock to sustain earnings growth because the top line is heading south, we're going to see a stock market that needs the Fed put to be reinstated. And that is only going to happen in one way. The Fed has got to be very aggressive, not just talk about ending asset sales this year, but to do it and to commit to a quick end and then revisit or promise to place a put, if you will, in front of the stock market saying that we will catch a falling knife for you if the dollar unravels. And better said, sorry, if the stock market unravels, we will revisit QE, and then we're off to the monetary bubble chapter or sequel. All right. Now, what that means for the value of the dollar when people figure out that there's no way out of debt monetization and currency debasement, that's what hasn't hit home yet, and that is both a huge risk and a huge opportunity. A risk for those invested in long duration dollar assets, and an opportunity for those that can get out of harm's way and buy them back at much, much more attractive risk return levels, in plain English, at much lower prices. Call the US and the US and US-based assets, US dollar-based assets, that dirtiest shirt or shirts in the hamper, not the cleanest or least dirty. Namely, the country / the economy that has by far the largest debts and deficits. Hello? You cannot borrow yourself into riches, only into bankruptcy, or ultimately into withering fiat currency debasement that not even the world's reserve currency status will preempt. Caveat emptor as regards the buck and US assets. That's the takeaway. Plus, you can also only borrow from the future and from the rest of the world so long. Afterwards, you have to consume less and repay, just like a household, just like a company. And that points to secularly large growth headwinds. You cannot consume and repay debt at the same time. One has to give. So if the consumption function is 70% of GDP, what does that mean for US GDP growth prospects? Not too good. Sustaining the unsustainable, our toxic public policy stew. I hope that doesn't give you a stomach ache when I mention it, but it's the most compact way for me to say it. Be it regulatory or litigation insanity, be it unsound money and cronyism, redistributionism, third world amnesty, gross misallocations, loans that wouldn't have been made, investments that wouldn't have been made, and yield starvation that this brings with it and enables it and furthers it. This simply is going to make the upcoming currency and valuation resets bigger still, especially given our bubble valuations in US stocks and bonds. In the meantime, it'll virtually guarantee unparalleled stagflation in its wake that will make the 70s variety look like a walk in a park. Translation: we're going to try the people in power that don't want to yield back to constitutionalism, the rule of law, sound money, all that other wonderful stuff, including free market capitalism. They will double down on this until it's cardiac arrest, until the rest of the world will no longer accept money printed out of thin air. So this is going to guarantee both a weak economy for all the reasons mentioned, accompanied by ever higher levels of inflation, in the reverse of a productivity-led deflation or a wealth of nations trajectory. The impact of this on asset prices could not be more substantial. As I showed you many times with this chart right here, I apologize, right here, all right, where bonds and stocks travel together, right? That's the key. In other words, earnings yields and bond yields go up and down together. As bonds get less attractive, bond prices fall, earnings yields also have to reflect this. They rise and the PEs fall. Said differently, bonds and stocks travel together in terms of rising prices of stocks and bonds. Both of them reflect a discount rate, which is bound to go up given the humongous and growing monetary inflation risks and insolvency risks. And the two, again, are tied at the hip, because monetary inflation in an extreme case is nothing other than a piecemeal default. Investors, to sum up, have amazingly not connected all these foreboding dots. Otherwise, stocks and bonds and the dollar wouldn't be where they are today. When Finance 101 and Econ 101 finally pop, our central bank engineered US and to a large degree OECD asset bubbles. In the OECD realm, it's mostly the bonds. That pop will be commensurately larger given how overvalued traditional assets have become, again, especially bonds, after a decade of unparalleled global financial repression. Layer on top of this, back to the outset, the blinking red trade and government, US government deficits, the blinking goods trade and US government deficits, which continue to grow even more strategically unsustainable, meaning creditors will bolt. And what do you have? You have an upcoming reversion beyond the mean in the making, like we've probably never seen before. The market, Mr. Market, is a manic depressive. And boy, the mania we have through financial repression is unlike anything we've ever seen, especially on the yield front. And as a result, levitation of bonds and stocks and real estate. This is going to ultimately, when it buckles, when it ends, hit bonds, hit the buck, bonds and stocks very hard, and is going to reset portfolios in the process, that is, those that are still in harm's way. Call it a reallocation opportunity continued with ever less sand left in the hourglass, a reallocation opportunity out of the book, out of long-lived, long-duration US dollar-based and OECD bonds, out of the very overvalued US stock market given the earnings implosion ahead, both in absolute terms and also in relative terms. This is the obvious bet, right? This is what no one is seeing, and therein lies the huge reversion beyond the mean allocation / reallocation opportunity. I hope you have found this of interest. Thanks for tuning in. Bye-bye.